Business 500D, Business Finance, the study of financial management. This is Professor Hasse. This is week number 2. I'm a little late this week. I apologize. I've had tons of computer issues this week. Had to even go out and buy a new one. So that's why I'm a little late, and I apologize, but we'll get back on track. Our topic this week is the time value of money, one of the key things, key disciplines in financial management. What is the value of money? Also, we begin our discussion going into next week of risk and return, the capital asset pricing model, beta. There's no graded work this week. I will post your grades from your discussion posts and your portfolio work by the end of this week, Friday, and I will post a video of that review. Also in that video will be the introduction of assignment number 1, which will be posted this coming weekend and due Sunday, June 26th, our first major assessment of this course. So our topic of the day, and I'm sure some of you have already studied it in undergraduate studies, the concept of time value of money. But to refresh ourselves, here's a nice review video explaining it.
Taken any accounting courses or any basic finance courses, you've probably been exposed to something called the time value of money. So we hear this concept a lot, and it's something very important to the foundations of finance and to some degree accounting. So we want to talk about, well, what does this mean from a conceptual point of view? What is the concept here? What are we talking about when we say that money has a time value? So let's look at this through an example. So let's take an example here. Let's say that I offer you 2 options. Okay, now one of the options is going to be that I give you $100 cash today. $100 today. And then in the other option, we're going to say that I give you, let's change colors here again. Let's say I give you $100 1 year from now. 1 year from now. Now, let's just assume for a moment that when I say I'll give you the $100 1 year from now, that's certain. That's not something that I might not pay it or something like that. It's guaranteed. You either get $100 today or you get $100 1 year from now. But either way, there's no risk associated with it. You're going to get the $100. So let's look at these 2 options. Now, which would you prefer? Now, you might say, well, I just prefer the $100 today because I just want the money. I have something I'm already going to spend it on. But let's just forget about that for a moment. Let's assume that you don't necessarily have anything you want to buy, but you do want the $100. Well, you might think, well, I'm indifferent whether I get it today or whether it's 1 year from now. But let's think about this, because the money has a time value. Now let's illustrate this. So let's look at a little timeline here. So here, in this option, we're getting the $100 right here, which we'll call this, that's today, right here. This is today. And then over here, this is 1 year from now. 1 year. Now let's go down to our other option, and we'll have a little timeline. And again, we've got right here is today, and you're not getting anything today. There's nothing here because you're getting it 1 year from now. You're going to be handed right here $100. Now let's think about things here for a moment. So when we get the $100 here today, what can we do with that money? Well, you could go out and spend it or something, but let's just assume that you didn't spend it. Well, what else could you do? You could invest that money. Now, let's say that you invested in something and you ended up getting a 5% return. Let's say you took it to the bank and you got a 5% return on some kind of investment. Now, what's going to happen is that at the end of that year, you don't have $100 anymore. Well, what do you have? You're going to have 100 times 1.05, which is going to be, that's going to be $105. So we see that if you get the money today, if you get it sooner rather than later, there's a value to getting it earlier because it can be invested to earn a rate of return. And then at the end of the period, you end up having more money than what you started with. Now, when we look at the other option where you get $100 at the end of the year, you didn't have the option of investing it here because you didn't have the money. So when you get the money sooner rather than later, there's more value there because you can go ahead and invest the money and earn a return on it. So that's what we're talking about when people say that the time value of money. They're just basically saying that money is something that if you're looking at cash flows, cash flow today or cash flow in the future, a cash flow today, all else equal, the same amount is going to have more value because it can be invested for that return. So now you might be thinking, well, how does this have real world applications, or what are we thinking about? But let's say we've got some project that the firm is thinking about. That project, you might say, okay, well, we're going to buy this machine, and it would generate cash flows over a period of, let's say, 5 years. So you can look at these different years, and you can go and say, okay, here's year 1, 2, 3, 4, 5, and you can say, okay, well, we estimate that in year 1, if we get this machine, we're gonna have $100 in cash flow. In year 2, 175. Year 3, 200. 300, and then let's say in the last year it generates 50. But what you can do is say, okay, well, now we know we're estimating these cash flows, but now what we want to do is we want to say, okay, well, like for example, here in year 5, that $50, we can't just add all these together and say, okay, well, now we've got this sum and this is how much it's gonna generate from this price. We have to take into account that $50 5 years from now is not worth the same as $50 today. So what we're going to do is account for this time value of money. And TV, maybe not the best acronym I have there, but the time value of money, we're going to look at this and we're going to say, well, what if we can just go ahead and say we earn a 5% interest on all our investments? Then we can say, okay, let's figure out what that $50 5 years from now is worth in terms of today's dollars. And when we do that, what we're doing is called discounting cash flows. So we're discounting cash flows. So that 50 here, this is a cash flow in year 5. And what we're doing is we're saying, what's the rate of return we could have earned on money today? Let's say 5%, 7%, whatever it is. And then let's use that to go ahead and discount this number and say, so it's going to be something less than 50 because maybe it's 30 or 35 or whatever, depending on your discount rate, could have been invested today to get 55 years from now. So when we talk about discounting cash flows, what we're doing is we're using the time value of money concept and some other formulas that we're going to talk about in other videos to take future cash flows and figure out what are they worth today.
Here's our Blackboard site, and a couple things to point out for this week, number 2. Our learning assignments for this week are this lecture video, the time value of money, chapter 4, and a review lecture spreadsheet, which I'm going to talk about right now. And here is where that spreadsheet is located. Week 2 lecture notes. This is a good template explaining to you the time value of money, just like the gentleman there. The concept of time value of money that we're going to apply to this MBA class is discounting, taking future cash flows generated by an investment and discounting them back to determine today's value of that investment return. And that's what we're going to look at in this spreadsheet. Here's the video we just saw, some additional videos. So again, chapter 4, time value of money for this week. So here's this spreadsheet that I was talking about. So I urge you to download this and just keep it as a template and a review note. And it includes 4 chapters, chapter 4, 6, which we're going to talk about tonight, chapter 5, which is on bonds, and chapter 7, which is on stocks. We'll be covering these over the next few weeks. Your assignment that you're going to have posted this weekend will cover chapters 1, 4, and 6. And I'll introduce that this weekend. I hope everybody's doing all right this summer. Online study is a little bit different and challenging. If any of you have any questions or concerns, please feel free to contact me via the discussion board, via email. Please, if you have any concerns, just let Professor Hasse know. So here's a problem here, kind of similar to what the video the gentleman just gave us, where we have an investment of $100,000. In other words, we're investing in an asset of $1,000. And we project that the revenues minus the expenses and the cash flow generated from this investment over its depreciable life of 10 years is $140,000. So an investment of $100,000 is going to produce a return in total dollars of $140,000. But is that the proper analysis to do in finance? And no, it's not. We have to take these future cash flows being received in the future, and what is their discounted cash flow today? Discounted cash flow today. And how do we measure, or what's the discount rate? It's the cost of the capital. Let's say this company took out a bond or got a bank loan to get the 100,000 at a 6% interest rate. So that's called the discount rate. It's the cost of capital. So we're going to take this $140,000 being received over 10 years and determine what is this $140,000 worth today, discounted at 6%. Formulas, function, financial, and we look for the function NPV, net present value. There it is right there. All our nice spreadsheets, Apple numbers, Excel, Google spreadsheets, all have functions. We want the NPV function, which is going to be determining the discount rate of the discounted cash flow. So we bring up NPV, we put in the interest rate, which in this case is 6%. That's our cost of capital. And then under values, all we do is we paint from year 1 to year 10. Year 1 through year 10. And this 140,000 discounted at 6% equals $96,122.63. Whoops. It's now below the initial investment today. So our NPV is the difference between the investment and the discounted cash flow. Our NPV is negative $3,877.37. That's a problem because our money's costing us 6%. This is only returning us. We can determine the return in a percent very easily by using the internal rate of return method. Also, another function, let's see that. Function, financial, IRR. If we take under values the investment of $100,000, let me just redo this spreadsheet here. Let's add another column here. Make this easy to understand. There we go. And we'll call this year 0. And that's the investment year. And we're investing $100,000. Okay, now what is the return in this in a percent? Formula, as I was starting out before, formulas, function, financial, internal rate of return. And now under values, we just paint from year 0 to year 10, the length of it, and we get an interest rate. Let's go to 2 decimal points, be official here. we get a return of 5.33%. So now we understand why this is a negative NPV, because the actual return in a percent over the 10 years is less than our cost of the capital. We got a problem. Either to solve this problem, we have to find a way of increasing the cash flows over the 10 years or find cheaper money. And today, June 15th, 2022, are we going to find any cheaper money? I don't think so. Inflation is 7%. And today, the Federal Reserve of the United States increased the discount rate by a whopping 0.75%, the greatest increase in 40 years by the Federal Reserve to the discount rate. Money is getting more expensive. When money gets to be expensive, valuation and return go down. And that's one of the issues confronting the economy right now that a lot of people are nervous about. We might go into recession because money is becoming more expensive, and coming out of the pandemic, we're not earning as much as we should. Thus, that has a problem. A discussion for another day. But this is the key point of the time value of money for this financial management class. We use that concept of discounting to determine the return over a future cash flow in relationship to the investment. This concept is used in capital budgeting. It's used in investment return analysis. It's used in stock management. This is a key concept you need to be aware of in Chapter 4, discounted cash flow. And here's a perfect example of it here. In Chapter 6, when you start reading that, it's talking about risk and return. And we'll talk more about this in our video in the weekend and into next week. But what we're talking about is that when we make an investment, what is the risk to the people giving us the money? Is it high risk or low risk? Well, risk is defined in Chapter 6 as beta. Beta is a statistical regression analysis of the standard deviation of a set of returns compared to the market. Give you an example of beta. Today, the 10-year United States Treasury yield closed at a return of 3.371%. That's the yield. That is a beta of 0. No risk whatsoever. That's why they call it the risk-free interest rate. There's no risk. So if you want to make some money today with no risk, buy a 10-year United States Treasury yield. You'll get on $1,000, $33.71 a year for 10 years. But if I want average risk, which is the beta of 1.0, that's average risk, that means the return on the Standard & Poor's 500 index. Right now, as of today, that Standard & Poor's 500 index has a market return of 10%. So if you want average risk, which is still risky, remember beta 0 is no risk at all, but average risk means you're going to get that return, but there's a chance you might lose it as well. But that return is at 10% today. Well, let's say I have a company called AA Corporation. And AA Corporation, like any corporation, calculates their beta over 4 years, a rolling average over 4 years or 16 quarters. And that beta for this company is 0.80. 0.80. So naturally riskier than the 10-year United States Treasury, naturally riskier and less risk than the market return. So again, remember, this is the 10-year United States Treasury yield. This is the S&P 500 market return. And this is the return. So the question is now, how do we determine the return or the expected return for AA Corp? Well, we use what is discussed in chapter 6, which you need to study. We need to study and understand the capital, asset, pricing model, which takes the return of zero risk, the return of average risk, and compares it and correlates it with the return of the beta of the company you're seeking the information for. And here's the formula here in this cell. It takes the risk-free interest rate and adds that rate to what is called the market premium. The market premium is the difference between the market return and the risk-free rate. That's called the market premium. And that amount is multiplied by the beta of the specific company. So if I take 3.371%, add that to the difference between 10% and 3.371% times 0.8, I get 8.67% expected return. This is also called the cost of equity. This is also called investor expected return. Why is it 8.67%? Because if I wanted to have no risk, I'm going to get a return of 3.71. If I want average risk, I'm going to get 10% return. But if I want a little bit less or better risk than average, like 0.8 in AA Corp, I'm going to expect to get 8.67% return. So my idea as an investor, if I really think and I look at the projections and the estimates of AA Corp, which every American corporation has to produce every quarter, their expected profits and cash flow for the next 12 months, if I think the company is going to make that 8.67% in the next year, I will buy the stock today. I will invest in it because I think I'm going to get my expected return. But during the course of those 12 months, if all of a sudden AA Corp is not doing as well as they projected, I have to make a decision as an investor to sell the stock and get out before it even goes down farther, or hang in there and hope the company can turn it around. Welcome to the United States stock market. People buy and sell based on the expectations that they anticipate getting as a return into the future. So chapter 6 is a study of the calculations and the definitions of those returns, both investor expected returns, and the definition of beta, which shows a correlation and a definition of the risk in the market. Need you to study these two areas this week, and then next week we'll get into bonds and stocks. But keep this spreadsheet. It will be our study guide for this week, and you'll have questions concerning itself with chapter 4 and 6 in addition to one in next week's assignment, which I'll highlight in my video this weekend. It gives you a good start. All right. So as we head into the middle and end of week 2, those are your study guides for the week. Again, no grades this week. I'll post the grades from last week in a couple days. If you have any questions, go to the discussion forum or send me an email, and look forward to continuing our studies into this weekend in Business Finance 500D. Thanks, everybody. Have a great week. We'll talk to you soon. Adios.